Good morning, ladies and gentlemen. I'm Roger Finley. I'm the Chairman of PGG Wrightson Limited, and welcome to our 2020 Annual Shareholders Meeting. Could everyone turn off their mobile phones? There are a few housekeeping matters before we get the meeting underway. In the unlikely event of an emergency, please make your way out the main doors to the glass-covered area opposite. Our convention centre staff will assist us throughout any potential evacuation. In case of an earthquake, please take cover, and once again you'll be assisted by staff. Our toilets are located to the right through the doors that you entered, and follow the signs. And for the benefit of those who were unable to attend today, I wish to advise you that we are recording the meeting, and an audio file and presentation will be posted on our website later today. I can confirm that we have a quorum present, and accordingly I declare the meeting open. This is indeed the very, very first occasion that our company and predecessor companies have held a shareholders meeting in Blenheim. We're delighted to be here in the wonderful Marlborough region that is so important to our business. And we are extremely proud today to have the Mayor of Blenheim, Mr. John Leggett, in attendance. Mayor Leggett, welcome. Board of Directors, we have in the room today Sarah Brown, sitting in the front row, my colleague David Cushing, our Audit Chair and Independent Director, with us today. Unfortunately, we do not have in the room with us today our two colleagues, Deputy Chairman Juhai Lee and Director U Ken Seng. They're both on the phone, as you may have heard a little bit earlier, and they will be available should you have any questions later in the proceedings. Obviously, border restrictions have not been a help to us, but I can assure you that we have operated throughout the lockdown fully as a well-operating board despite the COVID restrictions. Seated alongside me are members of the executive team, our exceptional and new. I think I explained that last year. Stephen has been with the business over 30 years and has been the chief executive as long as I've been chairman, and he's sitting on my immediate left. We also have our chief financial officer, Peter Scott, to his left, and at the far left of the table we have our general manager, corporate affairs, and also our company secretary, Julian Daly. But wait, there's more. We have a very good turnout of our senior leadership team here in Blenheim today. In the front row here are these extremely charming men and excellent lady Group Manager of Human Resources, Rachel Shearer, joined by our new dual role of GM Livestock and Real Estate, Peter Newbold. In the front row we have Peter Moore, who's in charge of our special ventures, livestock and partnerships. Grant Edwards, GM Wool. I can assure you that's never an easy job. Grant, thanks for coming. And very importantly, our retail and water network headed by GM Nick Berry, all in the front row, all available to shareholders and visitors to talk to after the meeting. I want to really stress our people at PGG Wrightson's. I want to express again the enormous gratitude that the directors have for the whole PGG Wrightson's team of around 1,800 people situated right across the country. I know all chairmen always say that, but in this year, this very special COVID year, our staff went above and beyond. They worked tirelessly through difficult, complex, click and collect, closed divisions, open divisions, a never-ending chain of restrictions on our businesses. This brings stress, and our staff have been quite magnificent this last 12 months, and I want to express the board and for shareholders their sincere thanks for your efforts. I'd also like to acknowledge several other notable attendees with us. We have our auditor, Peter Taylor, who this year has performed his personally last audit for us, but we're delighted to be continuing with KPMG. Obviously, partners rotate. We wish they didn't, but Peter, we will miss you. in direct charge of this audit, and it's been a privilege working with you. We have representatives from our share registrar, Computershare. We also have, I think we have representatives from our bankers facility led by BNZ, and we have Sandy Annan. I think we have Sandy Annan, Julian? Not sure if Sandy's here. Whether he is here or about to be here or not here, Sandy Annan represents the New Zealand Shareholders Association, who have constantly monitored and shown interest in our company and are a fantastic challenge and advocate for our business. So hopefully Sandy will be with us a little bit later on. No apologies have been notified prior to the meeting. Are there any apologies from the floor that we can take note of in our minutes? There being none, the Company Secretary has confirmed that the notice of annual shareholders meeting was sent on the 28th of September 2020 to all registered shareholders and to other persons entitled to receive that notice. As Chairman, I can confirm the minutes of the company's previous annual shareholders meeting held in a much less desirable centre called Christchurch on the 22nd of October 2019 were approved as a true and correct record of the board meeting at the board meeting on the 9th of December. And the minutes of the meeting are posted on the shareholder information section of our website. Our excellent annual report this year with square binding, it's a new thing, Annual Report 2020, the financial statements and the reports of the directors and auditors for the year ending June 2020 are set out in the annual report. And on the 28th of September this year, the report was forwarded to shareholders who have requested a copy, and those who have not requested a copy, it's available on our website and the NZX website. We have copies available today in the meeting room. I never like talking about accounting policies. We do, as a company, use both GAAP 2As and non-GAAP performance measures. Please note that we will refer to both. We use operating earnings before interest, tax, depreciation, amortisation, operating EBITDA as we call it, as a key measure of performance in this business, and I encourage you to refer to our full accounts for details of how this relates and balances to GAAP measures. Before I cover the key points of our financial results, please note that, like all suffering New Zealand issuers, our financial reporting has changed this year with the impact of the accounting standard IFRS 16. Many of you will have suffered under this. And also, we have obviously at the very beginning of the last financial year, the sale of our seeds and grain business completed, which makes our accounts a little bit unreconcilable. The new lease accounting standard was adopted from the 1st of July 2019 using the, Peter help me, modified retrospective approach, with the change only impacting the current period and not the comparative period profit and loss, cash flow and statement of financial position. And the sale of the seed and grain business that I referenced earlier are included in the comparative periods. Proxies. I can report that 186 shareholders have appointed proxies for today's meeting, and for the purposes, we have proxies in respect of approximately 36 million shares, which is roughly 50% of our shareholder base. I've covered the opening formalities, and I'd now like to move to the general business of the meeting. I'll begin by providing an overview of the 2020 financial year, and then I'm going to hand over to Stephen, our Chief Executive Officer. Stephen will provide in some detail the financial and operational highlights of our individual businesses, and will also summarise how our business is tracking in the current financial year. I will conclude our presentation today by discussing our all-important and brand spanking new forecast guidance for both income and earnings and dividend for the full year ending June next year. We'll then have an opportunity for questions, and discussion will follow before we move to the formal business of our resolutions, which are outlined in our notice of meeting. Today we have two resolutions, namely the hopeful re-election of Zhu Hai Li, our Deputy Chairman, and authorising the board to continue to determine our auditors' fees. So a few words on our operating performance for the year completed. At the risk of using a well-worn cliche, it was indeed a year of two distinct halves. The first half, we had a fantastic operating performance. The business traded very well to record an operating EBITDA, excluding this lease standard, of 23.7 million, which was up 33% on the prior comparative period. It's for the half year. The net profit after tax was 12.8 million. However, the second half, as is known to everyone, was impacted heavily by COVID-19, consequential, substantial operational disruption caused by the global pandemic. In the first half of the year, the shareholders benefited from a 234 million capital distribution, which was paid to all shareholders on the 14th of August 2019, which followed the completion of the sale of our seed and grain division. While the result for the financial year under review was not what we had targeted at the start of the year, it nevertheless reflects extremely well on the resilience of our business and our people, as well as the support from our customers, many of whom the board met yesterday, extremely loyal customers, and our shareholders who have suffered an extraordinary year of two halves. But to deliver the trading performance we did, similar to the prior year, after the level of disruption experienced, is indeed a heartening result and demonstrates that the business is in very good health. The business responded well to a range of challenges arising over the year, including COVID disruptions, various alert levels, temporary closure of some of our business units, wool, real estate, etc. Our dedicated employees rose to all of these challenges and supported our customers, our communities, our suppliers, and the rural sectors through all of these events. Our staff occasionally went and worked on customers' farms to help them through these difficult times. Above all, I am immensely proud of our staff and the way staff stepped up and responded to these challenges. We continue to look for efficiencies across our operations. As part of our continuing commitment to recalibrate our cost base, having obviously sold our seed and grain division, the board resolved earlier in the year to capture savings through reducing current board members to 5 board members from the original 6. And some of our directors have quite significantly reduced their directors' fees from April 2020. The combined effect of these changes has resulted in directors' fees reducing by approximately 18% when calculated on an annualised basis. Ronald Say retired from the board on the 31st of August 2019, having served as a director for slightly under 7 years. The board acknowledge and thank Ronald for his contribution as a director. I'll turn now to the financial performance highlights. There it is. Our EBITDA, operating EBITDA, was 45.2 million for the year ended June 20. Excluding the impact of the new lease standard, the operating EBITDA was 23.4, which was within the guidance range that we had messaged to the market, and it is similar to last year's result. Our net profit after tax was 7.8 million. Our earnings per share were 10.4 cents, based on a basic and diluted earnings per share on issued ordinary shares. And in August 2019, we made the previously referenced 234 million capital return to shareholders. An interim dividend was received way back on the 3rd of April 2020 of 9 cents per share. Reflecting, however, the extraordinary nature of this year and the ongoing global challenges, the fact the company had made a net loss in the second half of 4.9 million, the board determined, long before these decisions became fashionable, the board determined not to pay a final dividend. However, the board intends to resume the payment of regular dividends when the market stabilises, and I'll have more to say on that topic towards the end of this meeting. I'd now like to hand over to our Chief Executive Officer, Stephen Guerin, who will provide a detailed operational review. Thank you.
Thank you, Roger, Moreno, and good morning, everyone. As Roger has stated, the financial year was indeed extraordinary in a number of ways for PGG Wrightson's and the New Zealand and the global community. This year has had its share of general climatic challenges in terms of on-farm and market conditions for large parts of the farming community. Early in the second half of the financial year, widespread drought conditions across the country resulted in feed shortages on farm, with a consequential demand for shortage of meat processing capacity. This was exacerbated by the impact of the global pandemic on supply chains across the international markets, with further reductions in processing capacity due to pandemic-related operating restrictions which came into effect from early March. Although COVID-19 is affecting virtually all countries in the global community, the impacts and the timing of these varies from country to country. The pandemic put global supply chains under pressure, disrupted trade, and has resulted in market volatility, particularly at the premium end of the market. Despite this, demand has continued for New Zealand's primary exports as consumers worldwide place value on the provenance and security of their food. There is, however, a degree of uncertainty in the medium term as the economies and export markets respond to the pandemic. Global lockdowns have altered consumer behaviour, resulting in some primary producers having to change their product offerings and marketing strategies. The Alert Level 4 lockdown presented the challenges for farmers, given that it occurred at a time of year when autumn livestock sales were underway. The livestock industry faced several significant challenges, including the drought, with many farmers needing to move livestock due to feed shortages, as well as processing delays and processors needing to implement social distancing restrictions. The lockdown also came at a peak time for the crop cycle, with harvest in progress. Although harvest conditions were good across the country, harvesters also had to adapt to managing social distancing. The season generally saw good crop quality in the horticultural sector. While the international markets for protein remain relatively firm, the demand for added value products has reduced due to disruption of food services, restaurant trade throughout the world. This is expected to continue into 2021 and in turn could affect farm gate returns in the medium term. Access to funding was an issue for some farmers, with banks continuing to tighten lending in the primary sector in the last financial year, especially their exposure to dairy. New Zealand has made good progress with its strategy in eradicating Micropagus bovis, also known as M. bovis, with a number of infected properties continuing to drop, although some localised recent outbreaks remind us all we need to be vigilant. Our all supplies and fruit supply stores, along with the agri-trade business, wholesale business, were deemed essential services providers and remained open throughout the lockdown. Our teams did an excellent job in adapting quickly to implementing operating protocols to protect the safety of our employees and customers as they continue to deliver a first-rate service to our customers over this period. Our wool stores, real estate offices, livestock sale yards all closed during the lockdown, and our water business was only permitted to perform essential maintenance. With the reduced trading disruption in our real estate, water, livestock and wool businesses over the period of the COVID-19 lockdown, PGW applied for and received $4.1 million through the government wage subsidy scheme. Consequently, PGW finished the year with an operating EBITDA guidance within our updated operating EBITDA guidance range of $23 to $24 million, excluding the impact of the new lease accounting standards, and ultimately recorded a result within this range. Turn to cash flow and debt. Cash flow from operating activities was $34.2 million inflow. The capital expenditure for the year to 30 June 2020 was $11.9 million, which was $4.6 million lower than the comparative period for the prior year. The spend has seen continued investment in IT, including our Bidar online livestock trading platform and our e-commerce retail websites. It is important to note that as a seasonal business, our working capital requirements typically increase over spring into summer in line with the demand for farming inputs in New Zealand. Whilst the second half of the financial year was challenging due to the range of factors, including widespread drought conditions, supply chain issues for livestock and meat processing, and the global pandemic, we nevertheless maintained disciplined cash flow management. This resulted in an acceptable net debt position of $33.1 million at the 30th of June 2020, with an improved overdue debtor percentage compared to the prior financial year. It's also worthwhile noting that the resizing of our corporate support functions realised in excess of the anticipated $2.5 million cost savings for the financial year. We start our seasonal build of working capital for the current year from a sound position. I now wish to discuss a few of the operational highlights. I would like to spend a few minutes talking through some of the operational highlights we achieved over this year. Our bidr platform, which is our online livestock trading business, grew to 7 accredited agencies. The platform hosted more than 200 online auctions and traded more than 30,000 head of stock. Customer demand for our Go grazing contracts continued to grow through the balance peak, with the balance peaking just under $50 million. Our Go lamb has purchased more than 1.17 million lambs since launch. Our Go beef purchased more than 180,000 cattle since launch. Revenue from our independent wholesale business, AgriTrade, grew by 8% for the financial year. Our fruit fed supplies business continues to grow strongly. The technical R&D team carried out more than 50 trials for new product offerings, including more than 250 treatments during the financial year. Health and safety remains of paramount importance to us. We're proud of our lost time injury frequency rates reduced by 25% compared to our strategy baseline financial year 2017 actual rates. We are delighted to be able to host this year's annual shareholder meeting here in Blenheim. We spent an enjoyable time yesterday at Morisco Vineyard with the directors and our leadership team, and we'll take a bit more time to talk about that shortly. Marlborough is important to PGW. We are committed to supporting the thriving region. We have worked closely with our customers in Marlborough throughout our long history, and in many cases we have relationships that span many generations. PGW have witnessed significant land use change over the decades, and we have seen Marlborough transform from predominantly traditional sheep and beef farming area to a diversified region with strong viticultural and horticultural sectors. Marlborough is widely recognised as a key viticultural region with brands that are well regarded internationally. As a company, PGW has adapted the same changes to ensure we continue to service our primary production in Marlborough across the range of farming and grower sectors. To respond to this growth, in July 2016, we opened our new purpose-built store and office at the Westwood Business Park here in Blenheim, where we provide a full range of service offerings to our customers. This building is home to our Marlborough and Tasman regional office, our fruit fed supplies, our rural supplies stores, our regional real estate office, and our technical, livestock and wool representatives also operate from there. In Marlborough, we employ more than 40 staff between our Blenheim and Kaikoura stores. This number increases during the busy spring period. Our main Marlborough livestock sales yard is actually operated here in Blenheim. Throughout Tasman, we employ more than 40 staff across the Richmond and Motueka, Takaka and Murchison teams, and offering a full range of services. Our main livestock training facility is in Brightwater. Our retail store network is operated by teams of customer services staff who deliver a high level of product knowledge and service to our customers. These teams are supported by our technical field representatives and our technical horticultural representatives, who work alongside customers to drive value by providing technical support, product knowledge. We pride ourselves in striving to be market leaders in this space. In addition to our stores and on-farm servicing, we have a research and development team dedicated to trialling and developing new products under New Zealand conditions prior to commercial release, as we develop spray programs for horticultural crops in New Zealand to ensure maximum returns for our customers as well as food safety for the ultimate consumers. The technical team supports our technical field representatives and our technical horticultural representatives, as well as our customers, with an in-depth advice and a key range of subjects such as animal nutrition, animal health, soil science, agronomy, and horticultural needs. During the 2019-2020 year, the technical team undertook 50 trials and 250 treatments, as I've mentioned. For both those product offerings come through our fruit feed supplies business, our rural supplies business, and our agri-trade business. The field research team gives us a first-hand view of product and provides us with an unbiased insight into the product performances and differentiation some years before these products come to market. Our business in Marlborough and Tasman is strongly weighted towards our fruit feed supplies business offering, and we have 3 retail branches: Blenheim, Richmond, and Motueka. Our Blenheim store is the largest store in the country and consequently produces the largest turnover and the greatest EBITDA contribution to the company. Our Marlborough business is focused on grapes, and the Tasman business is more diverse, servicing kiwi fruit, vegetables, grapes, hops, stone fruit, berry fruit, and of course apples. The fruit feed supplies business is based around a strong, experienced rep team who offer specialist technical advice. Growers value the support our expert team provide, and our teams have become an integral part of our customer businesses as a consequence. Several of our reps have worked for fruit feed supplies for over 20 years. There continues to be a large amount of development taking place here in Marlborough and the Tasman across the horticultural sector. This includes new vineyard developments taking place in Blenheim, as well as continued increase in the size of area of hops grown in the Motueka Basin. Our team work closely on these developments, supplying much of the inputs, including wind machines, sprayers, and other infrastructure such as wire, posts, their needs for irrigation systems, as well as nutritional requirements. As I've mentioned, the board and executive team visited the Leafield Station vineyard yesterday morning and a number of the other properties within the Morisco group, including we had a discussion around their brand strategy, including the Ned, the King series, as well as the recently relaunched Leafield Station brand. Morisco have been a great supporter of the fruit feed supplies business, even before they started their first development nearly 20 years ago. Fruit feed supplies have been heavily involved with the development that has taken place at Leafield Station. The 2,300 hectare property was purchased in 2013, and since then our local rep, who's with us in the room, Blair McLean, has worked closely with Anton Rasmussen, Morisco's General Manager of Viticulture, developing and servicing the block. Blair has been there to support the business in the development of the 600 hectares that are currently in grapes. During the development, Fruit Feed Supply provide most of the infrastructure into this block, including 180 orchard right wind machines. Blair also looks after all of the Morisco's crop development and nutritional requirements. The relationship with Fruit Feed Supplies and Morisco is based around trust and adding value to their business. This has been a long-term relationship which I believe has benefited both companies. The relationship between Fruit Feed Supplies and Morisco is a good example of how we see our business being intimately connected to the region and to its prosperity. There's many other similar examples, and I can give for other key customer relationships that are enduring and provide us with confidence that PGW and Fruit Feed Supplies have long-term future in the Marlborough and Tasman regions. I want to now turn to our financial results for the year. Firstly, I'll talk about the Retail and Water Group results. The retail and water business incorporates our rural supplies, fruit feed supplies, agri-trade and water businesses. Retail and Water's operating EBITDA was a pleasing $34.7 million or $22 million, including the impact of IFRS 16 lease accounting standard. Excluding the impact of the new lease standard, this was $2.7 million, up on the prior year's results. Our rural supplies and fruit feed supplies business again performed well, and I want to thank the team. This year was challenging for the sector and the country, and as we've already highlighted. However, we continue to see anecdotal evidence of market share gains attributed to our strong technical offering and customer service. Our customers value the support we receive through our field reps, supported by our technical R&D teams, as well as our in-store teams, who are the glue that hold the organisation together. We successfully launched our e-commerce website in June 2020, allowing customers to transact online. At a macro level, farming returns are good and the outlook for red meat and dairy look favourable. A key issue impacting our dairy farmers and dairy support spend is the constrained access to funds as banks look to reduce their exposure to dairy. Our market-leading fruit feed suppliers business again performed well, with diversification across a variety of crops, continuing to adapt to our customers' needs. Our focus remains on added value to our customers' businesses by supplying specialist products and services and providing the best technical advice. Our market share remains strong in grape, pip fruit, stone fruit and kiwi fruit sectors, and are increasing our presence in avocados and cherries, which continue to see a capital investment. The business is well placed to benefit from ongoing technical advancements in viticulture through the grape developments. Optimism in the horticultural sector optimism in the sector is continuing to see horticultural development taking place and land use change, including large corporate growers diversifying their portfolios. This provides increased opportunities for the fruit feed suppliers business. We expect to see further new product lines added to our agri-trade range over the coming year, and we'll see good opportunity for continued growth in our wholesale business operations. Tightening on-farm credit and regulatory requirements, together with a lack of new water schemes, have continued to present a difficult trading for our water and business. Turning to our agency business. Our agency group incorporates our livestock, wool and real estate businesses. Trading for this group is generally weighted towards the second half of the financial year. Operating EBITDA was 15.7 million or 8.4 million, excluding the impact of IFRS 16 lease accounting standard. Excluding the impact of the new lease standard, this was down 7.5 million on the prior year's result. The largest business within our agency group is the livestock business. Our livestock business experienced a strong first 6 months underpinned by buoyant trading volumes and values. In the second half of the year, widespread drought conditions resulted in a high demand for meat processing capacity. The pandemic impacted the supply chain and access to international markets, and further restrictions on processing capacity were implemented when the country went into alert level 4 lockdown. These events, together with significant impact caused by the temporary closure of sale yards under alert levels 4 and 3, impacted on the business. The benefits of our real-time online trading platform came into stark focus during the lockdown, where necessity showcased the advantages of this channel to market innovation. The bidr team responded well and accelerated modifications to the platform to permit access to new users and response to demand, as well as to launch a new hybrid auction option. We see potential for the bidr platform moving forward and regard the innovation as important to the New Zealand livestock sector. Requests for our Go Grazing contracts, I've got to be careful with the words there, continue to grow, with the balance peaking at just under $50 million during the year. Under the program, PGW purchased and owned this livestock. When they are ultimately sold, the change in value of this livestock is the farmers less the agreed fees. Customers' demand for convenience and versatility of the Go program continues, and we expect to see further growth in the current year. Overall, livestock tallies were lower this financial year compared to the prior year. The largest impact was the effect of the reduced activity during the April to May 2020 period, when the sale yards were closed. Average livestock prices were also lower compared to last year. During the first half of this year, prices were higher than last year for both sheep and cattle. However, the pricing started to trend down in January due to drought conditions and the shortage of processing capacity, particularly in the North Island. Restrictions in supply chain further impacted pricing from April 2020. PGW came through a difficult year with depressed crossbred wool prices and associated worldwide demand impacting on the global pandemic. The pandemic is arguably the most significant issue the wool industry has experienced in a generation and has impacted on international wool supply chain. This has resulted in a decline in wool demand, orders and prices across all wool types. Therefore, our wool broking facility has facilitated the sale of fewer wool bales at lower margins. The rural real estate market continued to face difficult market conditions with declining volumes in all sectors throughout the year. However, the lifestyle and residential markets in provinces remained relatively positive. The pandemic affected the rural real estate market, leading to a market peak autumn selling period, but the business has seen encouraging signs return. An outcome from COVID-19 was a strong shift from traditional print media to digital channels, which we saw increased website traffic and social media use. Notwithstanding the challenging market conditions, PGW Real Estate improved market shares in its key lifestyle market and rural regions. COVID-19 continues to cause widespread disruption in the world, and we will do so for some time. While there is scope for optimism with strong demand and pricing for New Zealand's agricultural and horticultural exports, there remains a degree of caution with continuing volatility in global markets. With infection rates continuing to increase globally and secondary lockdowns occurring, a degree of uncertainty remains as to how this will impact on trade flows in the coming year. We are in a strong position to continue to serve our customers with both in-store and on-farm, and we're well placed to navigate our way through future lockdowns. We've built a solid foundation on which we can grow our business during future financial years. The horticultural sector continues to go from strength to strength, with the outlook remaining positive. The optimism in this area is supported by increased investment and land use change. The Fruitfed Supplies business is well placed as this market expands. The wool industry is experiencing record lows for the value of crossbred and merino wool is back substantially, although it is hard to predict when the market conditions will improve. We nevertheless believe in the positive properties of wool as a fibre that's sustainable and natural. The real estate business has witnessed increased interest in rural properties in recent months, which have been partially attributed to the lower interest rate environment. The COVID-19 lockdowns have raised the profile of key lifestyle properties and provided more space and freedom compared to metropolitan areas. We're encouraged by the performance of our online livestock platform Bidr allowed our livestock customers to continue trading stock during Alert Level 4 and Level 3 when sale yards were closed. We anticipate our Go grazing contracts will remain popular with our customers, and they appreciate the flexibility and simplicity of the program, and we expect continued growth in the program. Our e-commerce platform provides customers with additional channel to interact with us. As mentioned earlier, we continue to add value for online functionality to make our customers' interaction more seamless. Our approximately 1,840 employees are ambassadors of our brand, and more than anything else, they are what sets us apart from our foundation and the foundation of our business success. We continue to invest in making sure we have the right people who are well trained and equipped to deliver the service and products our customers require, whether it's technical expertise, industry knowledge, or on-farm solutions. 3 years into our safety and wellbeing strategy, we continue to encourage our people to assist transforming our culture to one of citizenship by embedding the cognitive behavioural safety program Zero Incident Process, also known as ZIP. Driving is one of our biggest risk areas in our business, and we have increased focus on this area recently through an investment in driver competency training. The popularity of Dr. Tom Mulholland, who specialises in rural health and mental wellness with staff and customers, saw us extend our affiliation with him into the second year. After 3 months of training, the year is pleasing to note that our training performance has been solid and in line with the expectations. Although this is a good start to the financial year, it remains early days with the peak of our busy spring training period still ahead of us. I'll now hand the meeting back to our chairman, Roger.
Thank you, Stephen, for providing that extremely comprehensive review of the year past. And just picking up a couple of points from it, I had the pleasure last night for the first time of meeting said Dr. Tom Mulholland, and I'm staggered that more corporate entities are not engaging with the sort of initiative that he's delivering. The ability for Dr. Tom to go to our 100 branches, take customers' blood pressures, test the blood pressures of our staff, usually higher than the customers. What a fantastic service and what a fantastic cooperation, Stephen. I'm sure that we'll continue to hear a lot more in that space going forward. So yes, thank you. I'll now provide an important update on our current outlook. We've been trading for 3.5 new months in this year. And of course, it does remain pretty soon. October and November are very big trading months for us. And moving into the second half of next year is where our livestock division really starts kicking in. And we're excited about that too. So there's a lot of the year still to go. It is soon. We also have this uncertainty of COVID-19, and let's hope we're increasingly hearing less of that. But the board considers it is nevertheless desirable to provide guidance in relation to expectations for the year ended June 21. Based on our current assessment, refreshed as recently as yesterday, the board considers that PGG Wrightson's is well placed to deliver an operating EBITDA result around $52 million in the year coming. That would be 30 million if we exclude the new lease accounting standard. Achievement of such a result would represent a very healthy 15% improvement on the prior year, or once again excluding the effects of this new accounting standard, and the headline will be a 30% increase is forecast for the year. It has been a pleasing start with businesses trading well. I'd like to single out the real estate division, which has traded magnificently in this first 3 months. We're seeing good demand in rural supplies, our crown jewel, fruit fed, retail businesses over the spring trading period. Livestock trading volumes, as I mentioned, have been sound. Sale yard throughput is bouncing back, having been closed through COVID. And there's been, as I mentioned, a really good uptick in rural and lifestyle real estate sectors with increased buyer interest. The first for quite some time. And well done to your team, Peter. Conversely, Grant, the wool market remains extremely challenging, and it's still very early in the trading year, several critical crop growing months ahead of us, along with the peak livestock style window in the second half. We're going to maintain a close watching brief on the impacts of the pandemic, particularly now as it affects trade flows and demand for our primary produce in world markets. This will have implications for PGGW. We anticipate being able to provide a fuller and hopefully more precise update on our trading outlook when we announce our half-year results in February 2021. And the last comment I'd like to make on this is on dividend. In the meantime, I'm going to reiterate that it is the intention of the board to resume the payment of regular dividends when our trading performance permits. Although a decision on the interim dividend will not be made until the half-year results, it is the expectation of the Board of Directors that an interim dividend of not less than 8 cents per share would be declared based on the trading performance remaining within our current guidance. PGW has an extremely strong balance sheet. We haven't heard that much for the last 10 or so years, but we do. We have a really strong balance sheet. We are incredibly well positioned to fund organic growth, the ideas of our SLT that are now bringing forward to the board. We can fund growth, and we are starting to see opportunities. We have an extremely supportive banking syndicate. How often have we been able to say that for the last 10 years? And have recently been able to secure agreement to extend our banking facilities for a further 2 years on extremely favourable terms, as you would expect in the current banking market. So that concludes our joint presentations, and we're up to that a special time of an ASM where we're going to ask for some questions. We have received some questions in writing before the meeting, and then, of course, we'll respond to those, and, of course, then we can take some questions from the floor, if that is shareholders' wish. The first question has been raised by a shareholder, David Tennyson, and he has asked a question about the funding position of the PGG Wrightson's employee benefits plan. I'm very pleased with this question because it's a topic very close to my heart, and I tend to raise it more than once per meeting. David has noted that under note 18 of our annual report, the actuarial equilibrium position of our plan is calculated on a different basis to the IFRS calculation of the plan. And he's requested that we explain why our calculation methodology differs from the IFRS standard. David, thank you for this question. Please be assured the board is extremely vigilant in this area. And at a general level, I've got to say that all defined benefit pension plans the world over are suffering greatly from two things: lower investment returns achievable and the lower interest rate and discount rate numbers that bed into the actuarial valuation of funds. So the cost of funding the liability worldwide is going up, and the returns on investments are going down lower. So I make that general point, and obviously the point that the board is extremely vigilant in the area. We've provided some slides specific to this question on the pension fund, which I would like to ask our CFO, who truly does understand them, to summarise. Peter.
Very good, thank you, and good morning, everybody, and thank you for the question, David. It is a reasonably technical answer, so I will try and keep the summary as understandable as possible. So, firstly, we do two things. We report our financial reporting standards for PGW under International Financial Reporting Standards, otherwise known as IFRS. And we record a net pension liability in respect of the obligations to the PGW Wrightson employee benefits, the plan, a defined benefit scheme, by the way. This is a sum of two amounts. Firstly, the defined benefit obligation, which is the amount expected to be paid over the remaining life of the plan, and is calculated on by an independent actuary using assumptions noted in the PGW financial statements. This obligation is then discounted back at the reporting date, in other words, the 30th of June in the case of our annual financial statements. Secondly, the fair value of the assets held by the plan in order to meet these defined benefit obligations is determined at the reporting date as well. To the extent that the assets are less than the discounted defined benefit obligation, a net liability is recorded in our PGW accounts. The key point to note here is that for PGW IFRS reporting, the discount rate used as prescribed by the standards is the 10-year New Zealand government bond rate at the time of the reporting date. So from a PGG Wrightson employee benefit plan reporting perspective, the plan is registered under the Financial Markets Conduct Act 2013. The FMCA requires the balance sheet of the plan to be reviewed by a suitably qualified actuary, and for the actuary to issue a report to be provided to the Financial Markets Authority, the FMA. The balance sheet shows both the defined benefit obligation and the plan's assets. In determining the defined benefit, it's important to note that it is not discounted based on the 10-year New Zealand government bond rate. It is per IFRS, rather it's based on the actuarial funding basis. The key difference between the two valuations is this discount rate that's applied. So IFRS reporting, as I said, uses the significantly lower discount rate of the New Zealand 10-year government bond rate, which at June for us was 0.91%. So what does that mean? That means that that when you discount them back the discounted back using the government bond rates is a much bigger number, so $9.8 million, and it means that when the actuarial does it under the plan, it is it's materially lower than the $9.8 million. So the main difference is just the two discount rates, the 0.91% prescribed by the International Financial Reporting Standards versus a higher rate when you discount that liability back. Roger, would you like me to do the second?
No. Well, yes, but no. So, thank you for that answer, Peter. It is an extremely technical area. We are thankful for the question, and I just want to add with one more theme. All pensioners in this fund need to be aware that the fund is absolutely solvent. We can meet all obligations as they fall due. We are talking about the balance sheet, one point in time. What is the funding deficit at one point in time? It's nothing about whether we can support these liabilities going forward. And there is an enormous difference between the IFRS actuarial deficit and the non-IFRS actuarial deficit. Secondly, there's two parts. One, these discount rates that Peter described very in detail. The second, of course, is the investment performance. But the fund is owned by the beneficiaries and it's managed by the trustees. We, the board of PGG Wrightsons, cannot go and tell them who to invest the money with or what to invest it in. It's a very good principle. They're in sole charge. However, twice a meeting, I do ask Stephen to impart to the trustees that we implore them to ensure they are getting the best investment performance on those funds. Right, enough on pension. Second question has been raised in writing we were asked why we had a large cash balance on the balance sheet at the 30th of June of 16.9 million, which is indeed another good question. The volatility of the group's cash position is very high, particularly as we approach that financial year end, on a day-to-day basis because it's dependent on our receipts from customers. We continue to focus on the management of our cash flow, including receivables, throughout the COVID-19 lockdown periods, including our 30th of June year-end day. This focus led to significant higher than expected payments being received in the last week and indeed the last 2 days, and in particular on the 30th of June itself. We received over $50 million from debtors in the 5 working days of June, the 5 final working days of June, and over $16 million were received on the last day, the 30th. This is due to much higher than expected debtor payments than we were budgeting. We much prefer to be in this position, of course, rather than having people owing us a lot of money. Since the 30th of June 2020, we are continuing to see positive improvements in our receivables, in particular with regards to our overdue percentage, which by all standards is extremely low. Balances over 30 days, you gave me yesterday, Peter, it's tiny. So that's it from the written questions. We have some microphones in the room with Sharon at the back of the room. We absolutely enjoy questions, and if any shareholders would like to ask us any, now's the time. Thank you.
Hello, James Lockie, shareholder. I'm interested in the growth of the Go platform and be interested in your comments on whether you see it growing significantly beyond the current 50 million in assets level in the current year.
James, thank you. We like Go too. We think it's a really important growth engine for us in the coming years. And I'd like Stephen in particular, if you'd like to take that question.
Thank you for the question. Firstly, in terms of the cycle we're at right at the moment, we're in a similar position in terms of numbers year on year to the same time last year. The peak in terms of the balance is generally in the February to March window that we have for based on the trading cycle of animals. In terms of where the business sees the opportunity, we do see growth. And we've discussed that with the board, and we have the support of the board to grow the product. And we have some activity in and around that. And one of the things about Go is that it's not, whilst it's a grazing contract fattening program for our clients, we are on farm every day with those clients, so we have a good understanding of what's actually going on farm, not just in the livestock training platform area. So we, with the support of the board, see there is a real opportunity there. In terms of a dollar number, obviously we've got a view about that in terms of arranging our banking funding facilities, and we've got a limit in terms of what we would think from a board perspective. The board have given us a number in around that, but we haven't yet peaked at that sort of level. So yeah, there is room for growth in the number.
Okay, do we have any other questions? Sir.
Good morning. Good morning. My name is John Ryden. I see in the shareholders list that you have a very large overseas shareholder. Do you expect or have had any approaches of takeover offers of that or any other interest?
The obvious answer is you'd need to ask the shareholder whether he's been approached. I'm certainly not aware of any. What I would say is our largest shareholder used to have a shareholding of 51%, currently has a shareholding of 44%. That's reflected in the composition of our board. We now have 5 directors, not 6. That particular shareholder has been an extremely supportive shareholder of this company for now 12 years. 12 years ago, the status and nature of PGG Wrightson's was fragile. And I think all shareholders owe a debt of gratitude to our largest shareholder, who's no longer a majority shareholder. But specifically as to, takeovers pending knowledge, I have none.
Thank you for explaining.
Sir.
Yes, Mr. Chairman. My name's David Tennyson. I apologise to the shareholders who had to go through that very technical explanation of my question, but I do appreciate it. So thanks for that, Peter. Just to sort of humanise it a bit, I suppose. I mean, PGG Wrightson's has got a long, sort of proud history and a lot of long, recently retired and still serving employees who are in that plan. So I think it's really important that the board keeps on top of it and makes sure that it does indeed fulfil whatever pension requirements they have going into the future. Even to the extent, and I may be a bit unpopular about saying this, but even if you have to reduce your dividend to make sure that that scheme keeps going, I think you should do so. Hopefully you won't have to, but I just wanted to put that point across. But I guess my main follow-up question to what Peter very ably explained was that interest rates have dropped. I, probably about 18 months ago, had a capital sum to invest in the bank, and I was offered what I thought was a fairly measly rate of about 3% at the time. And recently I had to roll it over and I was offered a very good rate. I think it was about 1.1 or something like that. So interest rates have really dropped. And I think the IFRS scheme is really reflecting that. And although we come from a history, I mean, we're all anchored to what we sort of have experienced in the recent past. And what I thought was a really miserly interest rate of 3% 18 months ago, I'd be very pleased to get today. And so I guess the specific question I asked is, the 10-year government bond rate is 0.91%, and that's the rate you had to use in valuing your accounts. And you said that your actuarial rate was higher, but you didn't actually say what it was. So I was wondering whether you could release that figure.
The IFRS, well, first there's two bits. The first bit is under agreement with the FMA, that we had a one-time offer dated by when, Julian? By December 2021, we had to make it whole. We did. There is no further obligation under the FMA for top-ups. Our obligation is to fund all pension liabilities when they come through. So this is a valuation exercise we're talking about. The shortfall of 9.1. Yeah. The value at the point in time of June was 9.1 million deficit under IFRS, 9.8. The number, the actuarial number, is less than 25% of that. But I want to keep coming back because there's a few pensioners in this room, or soon to be pensioners. The pension fund is fully funded. It is not an issue.
And I was going to say, I appreciate it's not a PGW issue. It's a global issue, really, isn't it?
Absolutely.
Yeah.
How many pensioners do we have in the defined benefit scheme?
Pensioners are about
200. Any further questions?
Thank you. Oh, just one other point I wanted to make. I just wanted to comment on your annual report. I think it's generally very good in terms of details declared and things, and also the presentation, some of the photography and things, just incredible, beautiful images of rural New Zealand, and really makes a difference. So I just wanted to add a bit of a bouquet to whoever put that together. Thank you.
Thank you very much, David. Okay. No more questions? Right. We now need to move to the formal business and some resolutions beyond absolutely thanking shareholders. We came to Blenheim. It wasn't certain that shareholders would all come, so we know a lot of shareholders made the effort to join us in Blenheim as well, and thank you. We'll now turn to the formal business of the meeting, being the ordinary resolutions in relation to the re-election of a director and authorising the Board of Directors to set the remuneration of our auditors. The two resolutions are outlined in the notice of annual shareholders meeting, and as always, we've offered shareholders the option to cast their votes on meeting business by post, online, post, or in person, and post. This option provides shareholders with more flexibility and convenience when they can't attend the meeting. I think it's probably, given the nature of these resolutions, it makes sense that we can do these resolutions by termination of a way of a poll. After the business of the meeting is concluded, those in attendance who have not yet cast their votes prior to the meeting will have the opportunity to do so. The proposed resolutions will now be considered by the meeting, with both resolutions to be determined by the poll that will be undertaken by our share registrar in attendance, Computershare. Our auditors and scrutineers, KPMG, are here to act, and the resolutions and the accompanying explanatory notes are set out in the notice of annual shareholders meeting. The first resolution, and I hope we have a nice picture. There he is. The first resolution is to consider the re-election of our Deputy Chairman, Joo-Hai Lee. Joo-Hai's biographical notes are set out in the notice of meeting. Unfortunately, as I mentioned earlier, Joo-Hai cannot be with us today due to border restrictions. He's a current Director and Deputy Chairman of PGG Wrightson, and he joined the board on the 31st of October 2017. Joo-Hai, being eligible, offers himself for re-election. The company's directors recommend shareholders vote in favour of Joo-Hai's election. Are there any questions in relation to Joo-Hai's nomination? Okay, so if you could lodge your votes and proxies in the normal manner, and as we leave the room to have some refreshments, people will be available to take your voting papers. The second resolution is on the auditor's remuneration. The proposed ordinary resolution is to authorise the Board of Directors to set the auditor's remuneration for the following year for the purposes of Section 207S of the Companies Act 1993. As is usual with audit fees, it is impractical to set the remuneration at the beginning of the year. Accordingly, we, the Board of Directors, are seeking your authority as shareholders of the company to set the audit fees at the appropriate time. And once again, voting in the normal manner as we leave the room, or have been done online. So thank you. I will now move resolutions 1 and 2 by way of the two separate motions. A poll will be conducted. For those who have not cast the votes, please complete your papers. And the results of the poll will be displayed on the projector screen following the conclusion of this meeting, and will also be announced on the NZX webpage. Ladies and gentlemen, the meeting is now open for general business. Are there any further matters for discussion, observation, or questions? And you're not allowed to ask any questions of Mayor Leggett. Hopefully you'll be able to stay some refreshments, Mayor. Sir, David.
Just go to get the microphone.
Yes, this is really a follow-up question on a question that another shareholder's asked about your new, well, not majority shareholder, but in fact your other new Chinese shareholder, which is the Beijing Holdings shareholding. I've been slightly puzzled as to what their specific interest in PGG Wrightson might be, because the homework I can do is that they don't really seem to be a similar business. Well, okay, they're in the rural sector, but that's about it. And so this is why I'm asking the question, whether you're aware of, are there any synergies and things between the two businesses where you can cooperate and maybe generate some value? But I've got a specific question on that, and I noticed you are now quite a substantial owner of livestock through the Go livestock program, and I'm wondering whether this new shareholder might be interested in perhaps getting a preferential access to some of the livestock you own for whatever use they might have for them.
Look, I'm more than happy to disclose that the delegation from BCA visited New Zealand 2019. We enjoyed showing them around our country, and they met various members of our executive team. As to the specific nature of their interest, it was, exploring New Zealand as a food source. It was the normal sort of inquiries that a major trade partner would make. As to their shareholding, there is absolutely nothing specific. We released to the New Zealand Stock Exchange a letter we had received from them, And I believe, Julian, can you quote from that release what they stated their interest was? It was a strategic interest. And they went on to absolutely assert that they are not a related party to any other shareholder on our register.
Okay, well, I'm sort of aware that the Chinese do tend to have a long-term view, so I'm quite happy to have them sitting there. I'm not worried about it, but just thought I'd ask in case there was any information that the board knew that they might like to disclose. But if it's just a strategic interest, I'm happy with that at this point. Thank you.
Thank you. Any other items of general business? No. Okay, that completes our business. The documents will all be on our website and they will be released to the media. The audio recording will also be released later today. And on behalf of the board, those present and those who unfortunately can't be with us, I really want to thank everyone for their attendance, and in particular yours, Mayor. Thank you for joining us. Please stay for some light refreshments, but do sign your paperwork as you go out of the room. Thank you very much, and looking forward to seeing you next year. Thank you.